be a competent investor, you need to be able to objectively calculate the total returns achieved on your investments, review them against appropriate benchmarks, and understand the risk you have taken compared with that of the benchmark. As we have discussed previously, you should be concerned about your total investment returns, after tax and after inflation. It's these returns that determine the real purchasing power of your investment portfolio. While inflation is outside your direct influence, we advocate that you should strive to maximise the pre-tax return on your investment portfolio for risk taken. Then, in order to minimise the tax payable on your investment returns, you should look to hold them in the most tax-effective entities. This approach is the rationale behind the tax effectiveness ratio, one of FinHealth's key indicators of good financial health or financial independence. To assess your investment performance, you should be reviewing your pre-tax investment returns against appropriate asset class benchmarks. For example, if you hold an Australian share exposure, a common benchmark is the S&P ASX 200 index, that is, a measure of the performance weighted by market capitalisation of essentially the largest 200 shares on the Australian share market. However, measuring the total pre-tax return of your investment portfolio and then choosing an appropriate benchmark to assess performance isn't necessarily a straightforward task. And the financial media usually doesn't assist with the choice of appropriate benchmarks, with its focus on convenient but often misleading indicators of investment performance. For example, we've previously addressed how the real estate media virtually never discusses total returns on residential property, focusing only on price change from one period to another. Cash flows over a holding period, for example, for maintenance, improvements, actual or notional rents, etc., are usually totally ignored. Unfortunately, to the best of my knowledge, reliable benchmarks of residential real estate total returns are unavailable, although there are indices, for example the CoreLogic Home Value Index, that attempt to account for compositional changes, for example improvements in the housing stock over time. In the rest of this video, we examine why the indices of share market performance that the financial media usually focus on are inadequate as benchmarks. They are misleading guides both to long-term Australian share market performance and for comparing the local share market with international share markets. We also explain what share market benchmarks you should be comparing the investment returns of your Australian share exposure with when assessing investment performance. Hi, I'm John Lesky, recently retired personal financial advisor and founder of FinHealth, a tool to guide you to your financial independence. Generally, when commenting on the daily share market ups and downs, the financial media refers to movements in the ASX 200 price index for the Australian share market and, for example, the S&P 500 price index for the US market. Both indices account for the bulk of the valuation changes in their respective markets on any particular day. They give a good short-term measure of what each share market is doing. But for assessing long-term returns from share markets, they are misleading guides. The chart on the screen shows the growth of $1,000 invested in the Australian share market, consistent with the S&P ASX 200 price index for the period June 2005 to June 2022. The length of the period was limited by the ready availability of free data. The return for the 17 years was an underwhelming 2.55% a year, with the negative effects of the global financial crisis and early months of the COVID pandemic apparent. However, despite its popularity with the financial media, it's not an appropriate benchmark to measure the long-term performance of the Australian share market. Price changes are only one element of total return. The price index completely ignores the contribution to total returns of dividend payouts. The S&P ASX 200 Accumulation or Total Return Index captures this additional element of return on the assumption that each index member company's dividends are reinvested in that company's shares at the time dividends are payable to shareholders. The chart now shown adds the Total Return Index, revealing a considerably stronger return of 7.01% per annum, with dividend reinvestment responsible for an additional 4.46% per annum of return. But this still isn't the full pre-tax total return story for the Australian share market. The dividends paid by the top 200 listed companies in Australia carry a high level of franking credits, which need to be grossed up to calculate shareholders' pre-tax income. For much more on franking credits, see our article Frank Dividends and Tax Effectiveness. Assuming an average franking credit rate of 75% over the period, the chart on the screen reveals how allowing for franking credits affects pre-tax returns. The total pre-tax return achieved is now 8.3% per annum, with dividend reinvestment adding 5.6% per annum to pre-tax return, a considerably different story to that provided by the price-only index. The financial media also often compares Australian share returns with US share returns over relatively short periods, for example 12 months, using the S&P ASX 200 price index for Australian shares and the S&P 500 price index for US shares. Even ignoring the important issue that both share markets are in different currencies, that is Australian dollars and US dollars, again, the price indices are poor guides to long-term comparative performance. As previously, this chart shows the growth of $1,000 invested consistent with the S&P 500 price index for the same 17-year period to 30 June 2022. It reveals a 7.04% per annum performance, considerably better than that of the S&P ASX 200 of 2.55%, ignoring currency. Taken at face value, it suggests that the US share market considerably outperformed the Australian market over the period examined. However, in the US, dividend reinvestment adds considerably less to total return, 2.18% per annum, than is the case in Australia, as revealed in this chart. The total pre-tax return at 9.22% per annum compares with the 7.02% per annum before dividend gross up and 8.3% per annum after dividend gross up for the Australian share market, again ignoring currency. The total return gap is considerably narrower than suggested by the price-only gap. US companies have historically had much lower dividend payout ratios than Australian companies, retaining and reinvesting more of their profits into the business. This biases the makeup of shareholder total return to price, rather than income or dividends. The chart now shown compares the annualised contributions to total return for the Australian and US share markets for the period under examination. The much larger contribution of dividends for the Australian market is apparent. It starkly reveals the inappropriateness of using price-only indices to just suggest anything about the long-term comparative performance of share markets. While they feel the financial media's need to provide information on very short-term movements in share markets, the price-only indices are next to useless for assessing investment performance. So, the important task of assessing investor performance requires some serious due diligence. You're not likely to pick up a good idea of how you're tracking simply by following financial commentators and their summations of investment performance that appear in the mainstream media. You need to be able to 1. Calculate the total return, both price changes and net cash flows, for each investment in your portfolio for the period under consideration. 2. Compare that return with an appropriate total return benchmark for the relevant asset class for the same period. In many cases, such benchmarks may not exist or be freely and readily available. And 3. Realistically assess potential additional risk, particularly concentration risk, of your investment in an asset class with the appropriate asset class benchmark, which will invariably be highly diversified. You then need to judge whether you're being adequately compensated for taking any additional risk. Unless you apply these disciplines in assessing investment performance, it's too easy to fool yourself regarding your competence as an investor. Both investment returns may be less and investment risk more than could be achieved by simply investing in funds that track the total return indices for the major asset classes. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. And finally, thanks